You've been approved. The bank reviewed your income. They checked your credit. They ran the numbers. You qualify for a $520,000 home. Everything looks solid. On paper, it works. If an institution with billion-dollar risk model says you qualify, it feels rational to assume you can afford it. The approval email feels like validation. You did everything right. Stable income, clean credit history, responsible track record. That confidence is intentional. But there's one number they didn't show you. Not hidden, not secret, just never emphasized. Your approval assumes you'll allocate 41% of your gross income to housing, not take-home income, gross. That's the first crack. Let's say you earn $140,000 per year. 41% of that is about $57,400 annually, or roughly $4,780 per month. That's your maximum housing allocation under standard debt-to-income thresholds. But after federal and state taxes, payroll deductions, insurance premiums, and retirement contributions, your usable income doesn't remain $140,000. It drops. For many professionals in the US, UK, Canada, or Australia, the reduction is 25 to 30%. At 28% total deductions, your take-home income becomes roughly $100,800 per year, or $8,400 per month. Your $4,780 housing payment didn't shrink. Now housing isn't 41%, it's 57% of what actually hits your bank account. Viewer recalculates. Suddenly, the margin feels thinner. Approval assumes no major repairs, stable interest rates, predictable insurance costs, zero income disruption. But real life includes roof replacements that cost $12,000, insurance premiums rising 12% in a single year, job transitions that interrupt cash flow for 3 months, property tax reassessments after market appreciation. The system approves based on stability. Ownership operates in volatility, so either you can truly afford that house, or the approval formula was never designed to measure comfort. Today, we're going to calculate what your salary actually buys using stress-tested math, not lender math, because lenders optimize for repayment probability, not lifestyle quality. Buying power is calculated through income multipliers and debt-to-income thresholds, typically 28% for housing alone, 36 to 43% for total debt. These thresholds are based on historical default models. If borrowers stay within these ratios, default probability remains statistically manageable. Notice the language, manageable. A loan can be survivable without being sustainable. Survivable means you probably won't default. Sustainable means your life retains profit margin. Banks underwrite risk like portfolio managers. They don't ask whether you can invest 20% of your income. They don't evaluate your ability to compound capital at 7% for 25 years. They don't model whether your housing cost reduces career optionality. They model whether you'll keep paying. Let's stress test the $140,000 example. You buy at $520,000 with 10% down. Mortgage balance is $468,000. At 6.5% interest over 30 years, principal and interest is roughly $2,960 per month. Add $700 for property taxes, $220 for insurance, $400 for maintenance reserves, $250 for utilities, you're near $4,530 monthly. That leaves about $3,870 from your $8,400 take-home money. Now introduce one variable, a $3,000 unexpected repair. That wipes out almost an entire month of leftover margin. Insurance rises 12%, adding another $26 per month. Utilities climb 10%. Your employer reduces bonuses during a downturn, trimming annual income by $10,000. Your take-home drops to roughly $7,700 per month. Your housing cost hasn't adjusted. Now you're spending nearly 59% of take-home on housing. Nothing dramatic happened, just arithmetic pressure. This is the financial compression effect. When fixed costs expand, flexibility contracts. Your retirement contributions shrink from 15% to 8%. Investment capacity falls from $1,500 per month to $600. Over 20 years at 7% return, that difference compounds to more than $500,000 in foregone capital. Housing didn't just increase expenses, it redirected your compounding trajectory. And geography amplifies this distortion. A $140,000 salary in a high-tax urban center with 1.8% property taxes and volatile insurance markets produces a very different risk profile than the same income in a secondary market with 0.6% property taxes and stable premiums. In one location, housing absorbs 55% of take-home. In another, 38%. The house price isn't the only variable. Location modifies sustainability. Yet people still stretch. Social validation plays a role. Owning signals arrival. There's generational comparison. My parents bought earlier. There's fear of missing out. If I wait, prices rise. Urgency narratives override math. The pressure isn't often financial, it's social. But affordability should not be defined by maximum qualification. Instead of asking, what's the maximum I qualify for, ask what payment leaves room for setbacks? What payment allows consistent investing at 15 to 20%? What payment doesn't dominate my career decisions or trap me in a job I no longer want? Affordability should be defined as freedom retention. The bank measures default probability. You should measure life flexibility. Your salary doesn't determine what you're approved for. It determines how much risk you can absorb. And the difference between those two numbers is where most financial stress begins. In the next video, we'll map income ranges to safe price zones, not survivable ones, sustainable ones.